we've seen, a sharp, a rebound in a lot of asset prices, but we still, going forward, we still have a credit cycle playing out. So we still have many weaker companies, going bankrupt or being impaired, and that's going to take probably all of 2021 to sort out. And we have to look back all the way to the 1930s and the 1940s to find the last time that this happened, where we kind of ran into the zero bound with extraordinarily high debt levels. Yeah, so basically what we're seeing play out is what I wrote about in my February newsletter. And so back on February 21st, I published a piece talking about how this rising yield situation could impact, kind of different sectors. And it kind of started with a flow chart, right? So, if you get a continued stimulus and things like that, you're looking at kind of continued reflation or the potential for outright inflation. On the other hand, if they were to cut off stimulus or the talks were to fall through, you could kind of cut that inflation theme off prematurely. And so basically the flow chart started with, assuming that they're going to continue with stimulus, we move on to the next round. And then the thing is, okay, so if we get more stimulus, we get rising inflation expectations, you should start to see the longer end of the curve start to move up, because for the past year they've been submerged below the actual and expected inflation rate. And so even if you don't get high inflation, it would be natural for the long end of the curve to move up and go back towards even zero yields, let alone positive real yields. Then from there, it really is going to come down to what the monetary policymakers at the Fed do about this. And so if they don't intervene very heavily, then we're likely to continue to get steepening yield curve. And therefore, you'd want to be long things like banks, for example, and some of the other value plays, or in short treasuries, if you want to play it like that.
Yeah, basically, it's kind of the opposite problem of late 2019 repo spike. And so back then, you had too many T-bills compared to the amount of reserves in the system. And so they responded by, creating bank reserves to buy T-bills, essentially monetizing U.S. debt. Now, here in 2021, what's happening is that, they've done so much QE that banks are so full of reserves that they don't really have anywhere to put it. And they have certain kind of regulations like the SLR for how much, basically deposits they can accept and how much, overall balance sheet capacity they have. And so one of the things they're doing is basically reverse repo is kind of a liquidity sink. Banks are able to put that capital in there, and that stops, basically T-bill rates from going negative, and basically is a spillover. And part of that, it's compounded by the fact that the TGA is being drawn down. So the Treasury General Account is going back down from its very high levels of I think it peaked around 1.8 trillion. As that goes down, that money is getting pushed back into reserves, into bank reserves. And so that's also contributing to this excess liquidity. And so for this period of time, that's essentially a liquidity drain. You can think of it as almost the exact opposite scenario of 2 years ago. Yeah, so normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? Because you have kind of public funds coming in to shore up unemployment and things like that, while a lot of weaker companies start going bankrupt, and bigger companies cut down on hiring and try to shore up their balance sheet. And so this cycle's been quite odd because we haven't really seen a lot of deleveraging. We've had a very compressed time frame. But we've still seen, of course, the massive explosion in public leverage. We've seen, a sharp, a rebound in a lot of asset prices, but we still, going forward, we still have a credit cycle playing out. So we still have many weaker companies, going bankrupt or being impaired, and that's going to take probably all of 2021 to sort out. In mid-2018, and so we re-entered a strong dollar environment. We started to get slowing global growth, declining GDP growth rates. And of course, that came into a climax this year when we also got hit by the pandemic, and that kind of put the cherry on top and had a stepwise down function. And so, going forward, we still have this winter to get through. But I think as you look into late 2021, the global economy starts to look like it heats up a little bit, especially in terms of commodity demand. Yeah, so basically we're all familiar with the short-term business cycle, which is the 5 to 10 year credit cycle of boom busts. But every time there's the end of one of those cycles, we have a deleveraging event, and then we have policymakers come in, they cut interest rates, they do all sorts of fiscal spending, and they kind of short circuit that deleveraging. So the private economy never really deleverages as a percentage of GDP back to where they started that cycle. And so they only do a partial leveraging, let's call it halfway, and then they start building up leverage again. And so when you string multiple of those business cycles together over multiple decades, you get higher highs and higher lows in terms of debt to GDP. And you get lower lows and lower highs for interest rates. And that's what allows them to have more and more debt. But that starts to run into issues once you hit zero rates or in recent times, even mildly negative rates in some countries. And because there's not a lot of policy room to keep cutting rates, and debt is extraordinarily high at that point. It's certainly something I'm watching because it could affect policymaker decisions about when they want to taper quantitative easing. They might adjust some of the interest rates on excess reserves. And so overall, they might do some policy tweaks. They're also talking about making some of those facilities more permanent or broader, like the number of entities that can access those could be broader. And that has implications for long-term liquidity. But overall, it's there's a lot of kind of sensationalist content about that, about how it's going to cause major disruptions. I don't view it in that sense, but it is something I'm watching pretty closely because it basically is showing that we're kind of at maximum liquidity right now. That any more liquidity just gets sucked right out anyway. And we have to look back all the way to the 1930s and the 1940s to find the last time that this happened, where we kind of ran into the zero bound with extraordinarily high debt levels. And that's what's been called the long-term debt cycle. So Ray Dalio and others have popularized that term, and it's something that I've incorporated into my research pretty heavily. If you then look at Neil Howe's work, the demographics, the history specialist, in his book The Fourth Turning, he showed that basically every 80 years or so, you have a really big kind of change in the way societies function. You kind of tear down old institutions and rebuild up new institutions. It's usually a very, very difficult time period. I don't know if you knew it at the time, but all those fourth turnings line up with long-term debt cycles. It's just kind of how it works out, where we have kind of and what separates a long-term debt cycle from a normal short-term cycle is that a long-term debt cycle is normally associated with currency devaluation. And so basically debts get so high that policymakers can't deleverage them without the system collapsing. And so usually you have a rapid expansion in the money supply, and you basically devalue currency so that you take away some of those debts in real terms, but not nominal terms. And that's historically what we've seen, and it's already kind of playing out that way in this cycle as well.
On the other hand, if you expect the Fed to kind of come in and intervene and either do an Operation Twist, where they might sell some of their T-bills and buy some T-notes and T-bonds, or outright yield curve control in the more extreme sense, then that can, basically compress the long end of the curve and drive those real yields more, further back into negative territory. And so far, we're seeing that leg play out with the banks doing quite well, value outperforming growth, and a sell-off of treasuries. If you get a continued stimulus and things like that, you're looking at kind of continued reflation or the potential for outright inflation.
Private sector deleveraging and a public sector increasing their leverage, right? So basically, we're all familiar with the short-term business cycle, which is the 5 to 10 year credit cycle of boom busts, because it could affect policymaker decisions about when they want to taper quantitative easing. They might adjust some of the interest rates on excess reserves.